In this video we will discuss about first in, first out, or FIFO, method of inventory evaluation. FIFO, or first in, first out, it's an asset management and valuation method in which older inventory is moved out before new inventory comes in. The first goods to be sold are the first goods purchased. FIFO assumes that assets with the oldest costs are included in the income statement's cost of goods sold. The remaining inventory assets are matched to assets that were most recently purchased or produced. The FIFO method avoids obsolescence by selling the oldest inventory items first and maintaining the newest items in inventory. The actual inventory valuation method used doesn't have to follow the actual flow of inventory through a company, but it must be able to support why it selected the inventory valuation method. The FIFO method is used for cost flow assumption purposes. The costs associated with manufactured products must be recognized as an expense as items progress to later development stages and finished inventory items are sold. The cost of inventory purchased first will be recognized first under FIFO. The dollar value of total inventory decreases in this process because inventory has been removed from the company's ownership. The costs associated with the inventory can be calculated in several ways. One being the FIFO method. Typical economic situations involve inflationary markets and rising prices. The oldest costs will theoretically be priced lower than the most recent inventory purchased at current inflated prices in this situation if FIFO assigns the oldest costs to the cost of goods sold. This lower expense results in higher net income. The ending inventory balance is inflated. Let's look into the advantages and disadvantages of FIFO. The FIFO method is easy to understand and to implement. Statements are more transparent and it's more difficult to manipulate FIFO-based accounts to embellish the company's financials. FIFO is required under the International Financial Reporting Standards and it's also standard in many other jurisdictions. Pros of FIFO. 1. Easier to understand and implement. 2. Follows the natural flow of inventory. 3. Reflects the current value of inventory better than the LIFO method. 4. Required in some jurisdictions. Cons of FIFO. 1. Can overstate the company's profits due to the gap between costs and revenue. 2. Company may end up with higher income taxes. 3. May not truly reflect the flow of inventory, especially for innovative industries. Let's summarize out today's topic. 1. FIFO is an accounting method in which assets that are purchased or acquired first are disposed of first. 2. FIFO assumes that the remaining inventory consists of items that were purchased last. 3. This contrasts with LIFO, an accounting method in which assets purchased or acquired last are disposed of first. 4. Lower, older costs are assigned to the cost of goods sold under the FIFO method in an inflationary market, resulting in a higher net income than if LIFO were used.